Welcome to The Explainer. Today, we're digging into an analyst report that's making some waves. It slapped a big buy recommendation on Bajaj housing finance, and we're here to figure out exactly why. Okay, let's start with a number. 22.2%. What is that? Well, according to this analyst report we're looking at, that is the potential upside for Bajaj Housing Finance's stock. Yeah, a number like that, you gotta pay attention, right? It definitely makes you want to dig a little deeper.
So, what is the story behind that number? What's driving this strong buy recommendation? That's what we're going to do today. We're going to investigate the key evidence laid out in this report and see what's really going on.
All right, first things first. Why are we even talking about this company? Well, the analysts behind this report make it pretty clear. They're not just saying it's good, they're positioning it as a real standout performer in what's, a very crowded and competitive housing finance space in India. Right from the get-go, the report zeroes in on the company's incredible operational efficiency, and of course, its profitability. It paints this picture of a business that's not just getting bigger, it's getting bigger in a really smart, really effective way. That's the key difference. Okay, so now let's get to the fun part, the hero numbers, as I like to call them. These are the core figures from the report, the hard evidence that really forms the foundation for that big buy recommendation. Let's unpack them. First up, their assets under management, or AUM. Get this, it grew by a massive 34.8% year over year. I mean, that's not just growth, that's explosive growth. It tells you they're really capturing a big slice of the market. Then we've got return on equity, or ROE. It's sitting at an exceptional 22.8%. This is a super important metric. It basically shows you how good a company is at turning shareholder money into actual profit. And a number like that, yeah, that's top tier. And here's the kicker. They're doing all of this incredible growth, while keeping their risk incredibly low. Their bad loan rate, what's called the gross non-performing asset ratio, is just 0.85%. That's tiny. It shows their loan book is rock solid and super healthy. But a number is just a number until you put it in context. And that's what's so powerful here. That 22.8% return on equity we just talked about, look at it next to the industry average of 16.5%. It's not even close. It completely dwarfs the competition. This is what superior performance actually looks like on a chart. Okay, so the numbers are fantastic. We get it. But it leads to the big question, right? How are they doing it? What's the secret sauce here? What's allowing them to pull off these kinds of results when so many of their competitors are struggling to keep up? Well, the report points to what it calls 4 key economic moats. Think of these as their competitive advantages, the deep ditches that protect their castle from invaders. You've got the power of the Bajaj brand, which is huge in itself. Then there's their leadership in technology, which is the engine driving that amazing operational efficiency and super smart risk management we saw earlier. Let's double-click on that operational efficiency for a second. One of the best ways to measure this is a metric called the cost-to-income ratio. The concept is super simple. The lower the ratio, the better. It just means the company is really, really good at managing its costs while still bringing in the big bucks. And, well, take a look. Their cost-to-income ratio is just 21.8%. That's not just good. The report calls it industry-leading. This is where their investment in tech and digital platforms really pays off. It's their competitive edge in a single number. The report also brings up another key point, a capital adequacy ratio of 23.8%. Now, you can think of this as a massive financial safety cushion. It means they have a ton of extra capital on hand. This is so important because it lets them absorb any potential shocks, and it gives them the firepower to keep growing aggressively. It's the best of both worlds, stability and growth. All right, so that's the picture today, but what about tomorrow? Let's look to the future, because the analysis does a really good job of balancing the road ahead, weighing the massive growth opportunities against some of the very real risks. So in one corner, you've got these huge growth drivers. Things like the long-term demand for housing in India, which isn't going away, the continued trend of urbanization, and of course, the power of that Bajaj brand. But in the other corner, the report is very realistic. It points out potential roadblocks like fierce competition and the fact that the business is sensitive to changes in interest rates. It's not all sunshine and roses, and the report makes that clear. But even with those risks on the table, listen to this. This is a direct quote from the report about the company's own management. They expect to maintain a 20 to 25% compound annual growth rate in their assets over the medium term. So, yeah, they're aware of the challenges, but they are clearly very confident in their strategy. Okay, so let's recap where we are. We've seen a company with awesome performance, a really strong competitive edge, and a super confident outlook. It all sounds great, right? But this brings us to the final and maybe the most important question. What's the price of all this quality? Is the stock actually worth it?
Now, this is where it gets really interesting. At first glance, you might look at its price to book ratio and think, it's a little pricier than its peers. But you have to look at the whole picture. Its price to earnings ratio is actually lower than the sector average, which is great. And then you throw in that killer ROE we saw earlier, the profitability is just on a completely different level.
So, what's the verdict from the report? Well, it's pretty clear. The conclusion is that yes, you might be paying a bit of a premium, but that premium is more than justified by the company's superior growth and incredible profitability. The bottom line is you're not overpaying. You're paying a fair price for a top quality business.
So, if we were to wrap this all up, what's the core investment thesis here? Well, our investigation, guided by this report, has uncovered a company that's pretty much firing on all cylinders. You've got superior execution, a brand people trust, a scalable model built on technology, and to top it all off, excellent asset quality. It's the whole package. And that really leaves us with one final, provocative thought from this analysis. When you're looking at a company with fundamentals this strong, with such a clear runway for growth, maybe the biggest question isn't if to invest, but when.